Hello everyone, today's video is all about Amazon and the intended stock split, which is looking like it's going to happen in June. So what is a stock split? So this is when a listed company, listed on a stock exchange, decides to increase the number of shares in circulation. So take the example of Amazon, and what it's doing, it's saying, look, we're going to have what's called a 20-for-1 stock split. So in other words, at the end of the exercise, you will have 20 shares for every one that you hold now. So an additional 19 shares, a 20-for-1 stock split. Now, what is the reason for this? Now, normally the rationale given for companies when they say we're going to bring in this stock split, why would you do it? They say, well, it makes the shares accessible to more people, which is a good thing. So, the Amazon share price was several $1,000s. So even to have one share in Amazon, it's a significant outlay. So the rationale being that, more people can access and own shares in Amazon. However, that's what they're saying. But is that really the case? Because when you think about it, the so-called share ownership, fractional shares, has been around for some time. So it's been the case for many years now. Never used to be the case several decades ago that you could own a fraction of a share, a sixth, an eighth, a quarter of a share, whatever it is. You either had enough money to own one or you didn't own any. Now they've changed the rules. Been in for some years, fractional ownership. So you can always, for several years now, just buy a fraction of an Amazon share. So that whole rhetoric around makes it more accessible, all that kind of thing, that doesn't really hold too much weight. What is more likely the reason, and this is being commented on in the financial press, is that Amazon is trying to get into more what we call passive tracker funds. So what do we mean by that? Well, basically in the investment world, money flows into companies if they are on certain indices. Now, believe it or not, Amazon, even though it's in the S&P 500, it's not on the Dow Jones Industrial Index. Now, just a bit about how stock markets indices are constructed. So the FTSE 100 and the S&P 500 are all about market capitalization. How big is the market value, the total worth of each company, and that will dictate the weighting that is attributed to that index. So the S&P 500, FTSE 100 work in a similar way. However, the Dow Jones works completely different. And the Dow Jones has been around for well over 100 years, and it's all about a share price and who gets on it. And there's only 30 companies on the Dow Jones Industrial, and they have a rule that says the company with the highest share price cannot be 10 times more the share price of the company with the lowest share price. So the spread between lowest share price on the Dow and highest share price is 10 times. Now, Amazon's share price is, several hundred times higher than the smallest share price on the Dow Jones Industrial. So the rules forbid it to being on that index. However, when they do a stock split, all of a sudden the share price will come right down, and it'll probably end up being on the Dow Jones Industrial Index, which means billions and billions of passive tracker funds all around the world that invest on whatever's on that index will flow into the company. So that's how they will acquire new money, by being all of a sudden on one of the major world's indices that they weren't on previously. Because what's meant to happen in theory when you do a stock split, at the end of the day, the company size doesn't change. It's just that the slice of the pie or the slice of the cake that you own, you've got other, let's say your ownership in Amazon equates to a cake, and all of a sudden you've had one great big slice, and that's your share that you own. Now you're going to have 20 different slices, but it's still the same size cake. So in theory, what happens in a stock split, the market capitalization, the worth of the company shouldn't change. It's just that you've got way more shares. So each individual has a smaller slice of what they had before. But the total stays the same. So in that analogy, you've got your cake is an Amazon share. You've now got the same size, but it's just split into 20 parts. But you've still got the same amount in total, the worth. That's the theory. But what actually happened on the announcement of the stock split in Amazon is that the share price increased. The share price jumped on that announcement. Well, in theory, it should stay the same until the point at which you actually do the stock split. Then it comes down as you would have thought. But on the news of that impending stock split, it jumped. And the reason it jumped is probably due to the fact that analysts and investment people in the marketplace knew, come on, look, never mind the rhetoric that they're issuing to say, oh, more access for everyone else to, buy in to a cheaper share price. Yeah, that's great, but it's more to do with getting access to the Dow Jones Industrial Average, because of the way that is worked, and the access to it is all about the share price rather than the market capitalization. So just a quick video there on stock splits. And the real reason why we think Amazon are going down that route. It's not the first time they've done a stock split. They did one about 18 years ago. It tends to be the case on companies that really go from strength to strength and ramp up their size, 10x, 100x, 1000x, that these stock splits do indeed happen. It's not uncommon. But certainly the real reason possibly that it's happening now, like I said, get access to the Dow Jones, get on that index, and all the passive money that will flow from thousands of investment managers and pension funds all around the globe will come in, and Amazon will be the better for it. So if you like this video, just a little video on investing, stock splits there, please do subscribe, and I will see you soon.